So oftentimes when companies are looking at their own business, if they're thinking about selling their business or even looking at a potential acquisition, there's some fundamental balance sheet and income statement variables that every acquirer should look at and every business owner likely looks at with their leadership team when they're monitoring their own business. From an income statement standpoint, revenue growth rate and how a company is continuing to grow revenue or not grow revenue is an important driver when looking at a potential acquisition opportunity and the underlying value of a business. Then we talk about, besides revenue growth rates, different factors and different slices of revenue. So revenue segmentation, the revenue mix, factors like customer concentrations and customer mix. These are all variables that really influence the value of a company. Obviously, companies that have much more diversity and have more customers and less concentrated customer base inherently have less risk, which translates into higher value. So oftentimes we're talking to companies that might be going to market about their existing customer base and how that diversity will play a role in how a buyer will look at their business. And we'll use that same type of metric when helping a company acquire another business at looking at the customer base, looking at the revenue growth rate, looking at customer concentrations, customer segmentation, and those related factors.
Nice, well put. You know what I'm thinking about too, Chris, that something that you and I have in common is we have a unique perspective sometimes for these business owners because a lot of folks going through whether merger acquisition process, they've only done this once or twice. I imagine that as you're taking this high level look, you're thinking about all the other organizations that you've seen and have a different perspective on risk and opportunity that perhaps they've never thought of before.
Yeah, so we do bring that to the table. We're truly outsiders and by no means experts in their particular company or their particular industry, but there are several tried and true metrics that we look at when evaluating potential acquisition opportunities. And some of these are controllable for a company. You know, factors about expense structure and factors related to their working capital efficiency, their CapEx needs. These are more controllable factors that really drive the value of an organization. Factors such as I referenced earlier, industry outlook, industry position, these are somewhat uncontrollable factors for a company if they're thinking about selling their business or acquiring another business. So there, the timing becomes much more important. But there are, by and large, 15 to 18 factors that we see time and time again that we help companies evaluate when they're looking at an acquisition or they're looking at selling their own business and can give them a better feel for what their own business is worth or what an acquisition target might be, what might be a fair valuation.
I love that. It takes some of the emotion out when you can have a checklist, have a plan in place. And I also appreciate how you said that there are some that are controllable because that's where I come in. And I love to come in that due diligence phase when they're still trying to figure out the details and look at, well, what can be done even before potentially a deal is done from a visibility standpoint, and also just putting a value on some of the intangible things that they have on those lists, because I'm sure that you've seen that too. Business owners don't always realize the value of all of the things they have beyond their physical assets.
No, that's right. And I've had the privilege of advising over 200 family-owned businesses over the last 20 plus years. So, through that involvement, I've had the opportunity to see firsthand how buyers evaluate a target or how our client is evaluating a target that they want to acquire and looking at both the controllable factors and those factors that are outside of their control. And we do assessments for companies, and it's not a valuation. It's not based on discounted cash flow or theoretical models, but it's really based on, in today's market, what buyers and sellers see value in for a business. And we go as far as not only looking at the financial metrics, which are obviously very important, but some of the more qualitative factors. We will look at culture, we will look at leadership, we will look at employee base, future hiring needs, the scalability of systems, and a variety of other factors which we know whether you're buying or selling a business do impact the ultimate economics of a transaction.
Right, absolutely. And I like to look at too you mentioned the reputation, the culture, those things. Those are things that are definitely things that are on my mind when I'm looking at an organization and that adds and lends to that repeatability or that scalability that you talked about. It's not just what the value is, but are the systems in place for them to be able to continue to grow? Or maybe this year their numbers look really good, but maybe their history just hasn't been there, that they don't have that track record yet. So how can you prove that they're going to be in a position to do the best things the next year, the year after that, 5 years from now, that they're going to be able to keep growing?
That's exactly right. It gives an acquirer, whether you're on the buy side or the sell side of a transaction, another level of evidence
Mhm.
of confidence that the company has invested in, the next level of systems, the next level of people, the next level of IT to scale the business and prepare it for its next phase of growth.
Yeah.
And that's what a buyer, whether you're acquiring a company or you're in the position of selling your own business, really positioning it for that next phase of growth, not as much about the past, but what it can do going forward after the closing of a transaction.
Yeah. So who would benefit from an assessment of this type? Is it just companies that are ready to make a sale or to make an acquisition? Or would you recommend that for other folks out there just to get a better understanding of where they're at?
Yeah, good question. We do it for a variety of different businesses. So companies that maybe have never been out to market before. We've seen situations where if a company is thinking about a transaction in 12 months, in
Mhm.
24 months at some future point, um, doing a strategic, value and transaction assessment at this point in time really gives an independent view for the ownership of the value drivers of their business and what factors they may be able to influence before they ultimately pursue a transaction down the road, which is going to enhance their outcome. So it's ideal for those types of situations. It's also appropriate for businesses that may just be unsure about what an outside buyer might pay for their business. They want a little clarity about that before going to market. It's again different than a valuation. A valuation plays an important role, usually for estate planning and trusts, and matters related to the IRS and other types of treasury regulations. But if a company is serious about going to market and understanding what a third party buyer would actually pay for their business, this type of assessment answers that question.